All righty, folks, we're going to have a conversation with Jonathan from Convoy Home Loans, one of the lenders that we speak to weekly. But before we get into rates and activities, I think it would benefit for us to go back and revisit what happened with pending home sales this week and also discuss the conversation with the CFO of DR Horton, because I believe both of those things that happened this week are a sign of what's going to come in 2025. And I don't think people are paying attention. Jonathan, you ready to have this conversation?
Let's go.
So let's talk about pending home sales. So pending home sales, if you looked at them this week, they were undoubtedly a monster number. They were up something like 7.5%. And I don't think a lot of people expected that. But folks, as we have talked about ad nauseum on this channel, rates matter. And what we have learned, once again, it's the third or fourth time we've been on this merry-go-round, is rates approaching 6% unlocks a tremendous amount of demand. Now, where are we today? We are today closer to 7.1 than we are 6.1. So let me just be very clear. There is no chance that pending home sales are up 7.5% next month. Demand has fallen off a cliff. So we're going to talk about pending home sales because it's a mirror of what is happening in the existing home market. We'll talk about DR Horton in a minute because that's a sign for new homes. So, Jonathan, what do you think? What do you think of my logic?
Yeah, I mean, definitely. Obviously, a lot of the data we always track is behind, right? Which, unfortunately, with it being behind, it doesn't catch the current trends, right? Which right now, like you said, it has fallen off a cliff. I'm seeing escrows sit for longer. I'm seeing a lot of canceled escrows. So in terms of, I think that was in the data was from September, right? I think the thing
Correct.
that I read is from
Correct.
September. So September, October was like the lowest rates that we've seen in, beginning of October. Yeah. Lowest rates we've seen in forever, right? What feels like forever. So obviously that number is jacked up, I think, heavily because of that. And I think the next time it comes out, we'll probably see a huge drop off.
Yeah, there's no question. It's really funny to think about because this part of the window is really interesting because if you rewind the clock 12 months, you and I were talking about 8% mortgage rates. So you go from 8 to 7, activity is actually not that bad. You go from 6 to 7, it's just time and time again. All right, let's switch to DR Horton CFO because again, I think existing home sales and the CFO discussion is a highlight of what 2025 might look like. CFO DR Horton on their earnings call again. DR Horton, if you don't know, missed numbers, missed top line, missed bottom line, missed margin, missed units. It was all kinds of ugly. But what they did say is home buyers are trading down. They are buying smaller and smaller homes. Where they used to be focused on detached, they now are finding themselves trading down to attached. And this is just a sign that affordability is super, super stretched. Again, some people want to buy, they want to own, and they're having to trade down. So one of the things I think is happening in the new home market is hopefully more builders, KB Homes, Lennar, and others will see what DR Horton is saying and simply build smaller homes. Home sale. That was weird. We had a little Jonathan.
Yeah, can you hear me? I'm totally froze up.
We can hear you. Could you hear anything I was saying or not? Just the video.
I heard about just DR Horton and then it just froze.
Oh, we'll do that again. Sorry about that. Internet's being wonky here in Vegas. So again, what DR Horton CFO is saying is people are trading down. They're buying smaller and smaller homes. They're going from detached to attached. And then again, the only people who aren't playing at 7% mortgage rates are home builders, right? They're playing at 5%. So if we have 7% mortgage rates in 2025, I think existing home sales struggle and new home sales do okay. What do you think?
Yeah, absolutely. And obviously there's a demand for new home still, right? I mean, I have a lot of clients and I can only apply it, and I like to apply everything to what I'm seeing right now currently with us, right? A lot of
Of
new
course.
homes that are new developments, those are the newest escrows opening up. People are lining up for those. Those are just selling, whether they're just plots of land or, with a structure on them. So I'm seeing the effects of that, even if it's not, the lower rates per se, the effects of newer homes and the investment opportunity within the newer homes, I think, is growing. So I think that that's absolutely correct. Yeah.
Yeah. And then the last thing, the big boogeyman in the room that I don't think the average consumer is thinking about is, I think rates are going to be higher for longer. I just had a conversation with Claudia Sahm, a world-renowned economist, and I ran through my logic with her that I think the smart money, aka the bond market, has realized or starting to price in no recession. One of the reasons we had rates down at 6.1% before the Fed cut was the odds of a recession by the market were seen as high or higher. Now that we've seen relatively strong jobs numbers, now that we've seen inflation come in, now that we've seen GDP at nearly 3%, I think the smart money, Jonathan, is saying no recession. And if we have no recession, folks, we're not going to have 200, 300 basis points in cuts. We might have 100 basis points in cuts. So I fear that we're going to have 7% mortgage rates for most of 2025. And I don't think the public is ready for it. What do you think?
I mean, they're never ready for it, right? Anytime there's an increase, they're never ready for it. But I think that what people, and this is the conversation we're having a lot, Dustin and I, are saying that, hey, if you're in a situation where you're trying to wait for the market, right? You're basically gonna be watching the grass grow, right? Because there's no way for you to just sit on the sidelines and hope that you can jump into something at the perfect timing. And there might not be an opportunity for you to jump in because the market moves a lot faster than obviously grass growing. But by the time you watch it grow, like by the time it's fully grown, it's already too late for you to jump in, right? Because at that point in time, it's going to shift again. And the timeline for waiting, like you said, we're telling clients, it's not going to be a month, 2 months, 3 months, where all of a sudden you're seeing rates back in the fives, right? It's not happening. So there were a lot of like bigger names last year going into this year stating that rates were going to be in the fives and the fours, right?
Well, dude, Jonathan, I mean, it was not 6 weeks ago.
Yeah,
I was hearing some well-known mortgage guys saying we're going to have a 5 handle. And I remember coming out going, guys, I don't know what you're looking at. That's not happening.
yeah.
But they were adamant. I mean, a couple of them got ballsy and said we might get in the 4s. I'm like, what are you guys talking about? That's not happening.
There's no fundamental research, I don't think, in those statements.
That's all hopium. That's all hopium.
Yeah, I mean, or an attention grabber. But realistically, the fundamentals don't support that. Obviously, if you're looking at yields, and I talk to my clients more about yields these days than I've ever done in the past. And I say, hey, look at the yields. There's always a spread built in between the yield and where the rates are, right? And right now, with, like you said, jobs, even the election coming up, the policies, all of that, everything's at kind of a holding pattern. And you see that in the yields, where unfortunately in the yields, when you're talking about a holding pattern, it typically climbs up a little bit, right?
Yep.
We've seen a sharp increase in the yield and the increase in spread between whatever mortgage rates are and where the yield is at in over the last like 3-4 weeks. So I think we might be hitting more of like a plateaued type situation, because I don't see it jumping as fast as it was 2 weeks ago. But in terms of where we are right now, like it's more of the yield, the bond market's more like, hey, just kind of get comfortable where we're at, right? And yields need to start working again at where we're at, not where things people will hope it'll be.
Yeah. What I would tell again, so let's bring this home. Again, I am somebody who's thinking that rates will be between 6.8 and 7.2 for most of 2025, if not all of 2025. That said, if we have a 7 handle for 2025, I got good news and bad news. If you're a seller, it's going to suck. If you're a buyer, it's going to be amazing. Because again, buyers, especially investors, we never have to buy. right? We don't have to buy that house or that duplex or that quad. So folks, if you're a buyer, realize that you are in a buyer's market. Most of you have no idea what a buyer's market feels like because we haven't had one for a decade. We are in a buyer's market. This means you should be writing aggressive offers. You should be asking for closing costs. You should be asking for repairs. You should be asking for the moon in negotiating. This is not the time to pay list price. If you're writing offers at list price today, you're a moron. Just an absolute moron. It is a buyer's market. Use it to your advantage. And then, most importantly, write the deal so it makes sense today at today's rates. None of this date the rate nonsense. Write it so it makes sense today. And then if sometime in the future, 1 year, 3 years, 7 years, rates get better, congrats, refi. Don't plan for it. Write the deal so it makes sense today. Realize that in a buyer's market, motivated sellers are easier and easier to find. Most of you haven't seen a motivated seller. Most of you only know how to write at or above list price. This is not the time. This is not 2022. Get aggressive. Let's create some win-win great deals. That's what I tell people.
Absolutely. And I mean, I think some people might be offended by listening to that, right? And
I don't give a
because
offended.
Oh well. Yeah, it's funny because I like I said, I shared on the channel too. Some people get offended when I tell them, hey, what you're hearing from everyone else and what you're thinking is wrong.
Yeah.
Right.
Yeah.
And
I get that a lot.
Yeah. We've gotten comments on that, but then there's also comments that you've shown of people being like, hey, I listened to these guys and it was a lot better in result than not listening to them.
Yeah.
Right. So I think there
almost weekly you get some of those. So kudos to you.
Yeah, exactly. So it's a trade-off. We know what we're doing a little bit, right? We don't try to feed into the opium, right?
No.
Our job, and I feel this way because Dustin and myself, we're both avid investors ourselves, right?
Yes.
I probably wrote, and this is for the guys on the channel, like I've probably written 30 offensive offers over the last, I want to say 2 months of different projects, just trying to do rehab, development, whatever. Like it's happening, right? And that's the only way that you're going to land on something that can actually work. And again, people try to ask me like, hey, the biggest question I get is this. Hey, would this deal work if in like 2 months from now rates drop like, you know, to 5.5? Like, what do you think? Like, maybe I should do like a 1 year prepay or a no prepay and take an 8% right now just to bet for rates to come down to 5.5 in a few months. I'm like, hey, like if you're looking at it like that, like you're putting yourself in a worse position.
Yeah, it's a bad idea.
Especially if your loan amount, and this is the threshold that I tell a lot of clients, is like if your loan amount is like 200,000 or below, it's not really going to make that much of a difference if it drops from 7 to 6.5. You're not looking like the number just makes you feel better, but in terms of actual payment, which is what matters, it doesn't make that much of a difference.
It's like $8.
Yeah. Why are you stressing about that little? Yeah, why are you stressing about that little difference in rate just so you can feel better about it? It's not about like how you feel. It's about how it looks on paper, which is, hey, the best advice might actually not be taking a 1 year prepay or no prepay situation with a higher rate. It might be for certain loan amounts, take a higher prepay with a lower starting rate so that you can plan for longer and bet on the longer term versus the short term.
Exactly. Yeah, I love it.
Yeah.
The other thing we should talk about is for the longest time, we've talked about DSCR loans, you know, being kind of at even or at par with conventional. I think some of that might be changing, but we're also finding that more and more people are being cost sensitive. So for some of those folks, wouldn't you say it's, I don't know, I guess I'll use the word cheaper, more cost effective to try to fit in the box of conventional? I mean, it's harder, it's more rigorous, but if they can, isn't that a little better or no?
Absolutely. And I'm telling clients like, hey, look, you guys have the option, right? If you have the income and you're putting it in your personal name, you're not planning to move it into LLC, and you want to go through the process of underwriting, it's available, right? It's available as a cheaper option alternative to DSCR. You don't have to do DSCR, right? But the benefit of DSCR is where I try to kind of explain to clients on what it means. If you do DSCR, you close in the LLC, you can partner up with other people if you need to for liquidity. You can add, make sure that either when you 1031 later, you can 1031 in the name of the LLC. Like all this stuff that's added bonuses that you wouldn't think about on just trying to get the cheapest rate right now, right? Is kind of what comes into play on a DSCR. So yes, there is more cost to doing DSCR, and some people get really shocked because they're like, "Why is conventional? I was only paying like, $1,500 to do the loan, and now DSCR it's like $5,000." It's like, yes, because on conventional there's a lot of spread for people to just fit it in, right? So you can take a higher rate with it built in, you can take a lower rate without it built in, but DSCR doesn't work that way because it's all traded actively on Wall Street. And Wall Street chases the premiums as is, right? So if you're in a situation where you are very cost sensitive, right, we can help you with conventional. But if you
that's why I love Convoy Home Loans. Because again, you're doing books of business in both conventional and DSCR, and most importantly, you're willing to have a conversation, and you just put it out there. So that's why I think the audience loves you and Dustin, is because you don't really try to push anybody. You just speak facts. You give them the numbers for their situation, and you let them decide. I think it's just and again, you're thinking long term. You don't think about an individual transaction, which is pretty awesome.
Yeah, I think that's the main thing, right? If you have to have a long-term view for investment properties, because yes, the rate's actually not even cheaper, by the way. Like, just to put it out there.
Yeah,
like conventionals like whatever 7, 6, 8, with DSCR with 25% down, we're still getting mid 6, right? Low 6. If you do 20% down, high 6, still in there, right? So obviously, but it includes a prepayment penalty. But that is still an option where it might be, let's say conventional is like $1,500 versus, and this is the biggest example that I tell people, $1,500 for conventional, let's say, is the cost on the lender side. Let's say DSCR is $5,000. The difference there is $3,500, right?
Correct.
Over a 5-year period, are you going to make up that difference? Yes or no?
Probably.
Yeah. And I tell, but you also get the benefit of LLC, right? Which is huge for 1031 exchanges. People don't understand how important that is for a 1031 exchange, because if you try, and you know this, but like people, you can't switch LLCs and switch names and such when you're doing a 1031 exchange. So the most powerful tool in the world for tax benefit, right, is a 1031 exchange for tax deferral. And in order to successfully use that in the way that you want to use it, it's worth it to pay a little more, right? Because
you got to get the debt in the name of the, exactly.
100%. So if you're looking at that aspect versus just looking at, let me just save a little bit on the rate or a little bit on the cost, right? You're not looking at, I don't think a lot of people are looking at the bigger picture. They're only focused on this little, isolated picture. And our goal, your goal, my goal is to really have consumers and clients and listeners look at the bigger picture of everything, what's actually going on, and really just find people to help them, guide them through that pathway, to financial success. Yeah.
No, absolutely. That's why you're here. That's why you've been a partner for a long time, because, everybody you work with, you serve so well. Sometimes you have to say no because, again, the deal doesn't make sense. So if somebody wanted to reach out to Convoy Home Loans, they just go to what's on the screen, right? convoyhomeloans.com. And where do they click ORAD? I actually had somebody ask that. Is there a drop down? Is there a link? Where do they go? ORAD?
Yeah. In the form. We're updating it too again. So we're gonna add it in there. Yeah, it'll be on a Friends of Convoy page eventually.
There you go.
Yeah.
There you go. Where you go, folks. Just click the little drop down, say ORAD. The reason that's important, of course, is because you want to work with Jonathan or his partner Dustin. Otherwise, you end up with the plebes, and nobody wants to work with plebes. Work with the guys at the top. Thanks, buddy. I appreciate you.
Thank you.
And congrats to the Dodgers.
Yes.